Hey there! Welcome to the channel. If you're watching this, you're likely on a mission to build a financial future that not only provides stability, but also growth and the freedom to live life on your own terms. Whether you're a seasoned investor or just getting started, building a diversified investment portfolio is one of the most powerful ways to achieve that goal. In this video, we're going to break down exactly what a diversified portfolio is, why it's essential, and, most importantly, how you can create one that suits your financial goals. We'll talk about the types of assets you should include, how to manage risk, and the steps you need to take to build a portfolio that helps you sleep easy at night while also putting your money to work for you. So grab a pen and paper, and let's dive in. First things first, what exactly is a diversified investment portfolio? In simple terms, a diversified portfolio is a collection of different investments that span across various asset classes. Think of it as a strategy to spread out your investments in different areas, stocks, bonds, real estate, commodities, etc., so that if one area underperforms, the others can offset those losses. The power of diversification lies in the fact that no one investment or asset class performs well all the time. By diversifying, you reduce the risk of losing all your money in one place. It's about creating balance. A diversified portfolio minimizes risk while increasing the potential for long-term growth. And here's the most exciting part. Diversifying doesn't have to be complicated. It's all about making smarter choices to create a strategy that works for you and your unique financial situation. You've heard the phrase, "Don't put all your eggs in one basket," right? Well, when it comes to investing, this advice couldn't be more important. If you place all your money into one investment, say a single stock or sector, you're exposed to a significant amount of risk. A downturn in that stock or sector could hurt your entire portfolio. Here's why diversification is so crucial. 1. Reduces risk. The most obvious benefit of diversification is reducing the risk of losing a large portion of your money. Since different asset classes react differently to economic conditions, spreading out your investments helps cushion against downturns in any one area. 2. More consistent returns. Over the long term, a diversified portfolio tends to produce more consistent returns. While individual investments might go up and down, the overall portfolio tends to smooth out these fluctuations, providing steadier growth. 3. Capitalizes on different market conditions. Various asset classes perform well under different market conditions. For example, stocks may perform well when the economy is growing, while bonds tend to do better during times of economic uncertainty. By diversifying, you're positioning yourself to take advantage of different market cycles. 4. Peace of mind. If you're worried about the volatility of a single stock or asset, diversification helps calm those nerves. You'll sleep better knowing your investments are spread across various areas. So how do you create a diversified portfolio? Let's break down the most common asset classes you can include to balance risk and reward. 1. Stocks, equities. When most people think of investing, they think of stocks. These are shares in a company, and they can offer impressive returns, especially over the long term. However, they also come with higher risk because stock prices can be volatile. To create a diversified portfolio, you don't want to invest all your money in just one stock. Instead, spread your investments across various sectors, technology, healthcare, energy, finance, etc., and consider both large-cap and small-cap companies. Large-cap companies are usually more stable, while small-cap companies can offer higher growth potential, but with more risk. You can also consider exchange-traded funds, ETFs, and mutual funds, which pool together a variety of stocks and offer an easy way to invest in a range of companies. 2. Bonds, fixed income. Bonds are debt securities issued by governments or corporations, and they're typically much less volatile than stocks. While they don't offer the same high returns, They are a great way to provide stability and steady income to your portfolio. Adding bonds to your portfolio can help you balance out the risk associated with stocks. There are several types of bonds: government bonds, corporate bonds, and municipal bonds, each with different levels of risk and return. Generally, government bonds are safer but offer lower returns, while corporate bonds can offer higher returns but with more risk. 3. Real estate. Real estate can be an excellent addition to your portfolio. It offers diversification beyond the stock market and can provide regular income through rental properties or dividends from real estate investment trusts, REIT. Real estate is a tangible asset that often appreciates in value over time, making it a great long-term investment. Real estate can also act as a hedge against inflation since property values and rental income generally rise when inflation is high. 4. Commodities. Commodities like gold, silver, oil, and agricultural products are physical assets that can protect your portfolio during times of economic uncertainty or inflation. Gold, in particular, is often viewed as a safe haven investment during turbulent times. Commodities can be a bit volatile in the short term, but over the long term, they can add an extra layer of protection and diversification to your portfolio. 5. Cash and cash equivalents. Lastly, cash or cash equivalents, like money market funds or high-yield savings accounts, play an essential role in any portfolio. They are low risk and provide liquidity, easy access to funds. While they don't offer high returns, having cash in your portfolio helps you weather short-term market fluctuations and provides the flexibility to take advantage of investment opportunities when they arise. All right, now that we know the different asset classes, how do we actually build a diversified portfolio? Here's a simple step-by-step guide you can follow. Step 1. Define your investment goals. Before you start buying assets, take a moment to define your investment goals. Are you saving for retirement? A down payment on a house? Your child's education? Understanding your goals will help you determine your time horizon and risk tolerance. If you're younger and have time on your side, you might be able to take on more risk. If you're closer to retirement, you may want to focus more on safer investments, like bonds. Step 2. Determine your risk tolerance. Everyone has a different level of comfort with risk. If the idea of your investments losing value keeps you up at night, you may want to allocate more money towards safer assets like bonds or cash. If you're more comfortable with risk, you can lean more heavily into stocks or real estate for higher potential returns. Step 3. Choose your asset allocation. Once you understand your goals and risk tolerance, it's time to choose your asset allocation. This means deciding how much of your portfolio will be invested in stocks, bonds, real estate, and other assets. A common rule of thumb is to use your age to determine how much of your portfolio should be in stocks. For example, a 30-year-old might want 70% in stocks and 30% in bonds, while someone closer to retirement might have a more conservative split, like 40% stocks and 60% bonds. Step 4. Select your investments. Now that you've decided your asset allocation, it's time to pick the specific investments. As we mentioned earlier, you can invest in individual stocks, bonds, ETFs, mutual funds, real estate, and commodities. Do your research and select investments that align with your goals and risk tolerance. Step 5. Rebalance regularly. Over time, your portfolio will naturally shift as some assets grow and others decline. It's important to rebalance your portfolio periodically to maintain your desired asset allocation. This could mean selling some assets that have appreciated in value and buying more of those that have declined, or it could mean adjusting your risk exposure as your life circumstances change. Building a diversified portfolio is one of the smartest ways to grow your wealth over time. It's all about balance, reducing risk, and putting your money in multiple places so that it has the best chance to grow. The best part? You don't need to be an expert to get started. With the right knowledge and a bit of planning, anyone can create a portfolio that works for them. Remember, it's not about perfection, it's about making progress. So, what are you waiting for? Start building your diversified portfolio today and take control of your financial future. If you found this video helpful, don't forget to like, share, and subscribe for more tips on managing your money. You've got this.